So we looked at the solution conceptually in the last part. Now we'll look at the practical solution. And we are going to pay ourselves first. You've probably heard the saying, pay yourself first before you pay anyone else. This is how we're going to do it. We're going to deposit the money that we get in income into our own private bank before we do anything else with it. So we have our income coming in, and we are going to deposit it into a specially designed cash value life insurance policy. We are going to pay premiums into our cash value life insurance policy, and that is how we are going to pay ourselves first. When we pay those premiums into the policy, we have cash value, and that cash value starts earning for us from day one. It earns at a guaranteed interest rate, contractually guaranteed by the insurance company, meaning our cash value balance can never go down, it can only go up. And on top of the interest we're earning, we are also being paid dividends. So our cash value earns from day one. Just like before, we're not going to necessarily change our spending or investing or saving habits. We're just running our cash flow through a better vehicle. So we'll make our investments as before. The savings we'll keep in our private bank because it's earning interest for us. And we're going to continue to spend money. But our investments and our spending, we are going to finance it by borrowing against our cash value life insurance policy, utilizing a policy loan. So we're never going to withdraw any of our capital. Therefore, all of our capital, 100% of it, keeps earning for us inside our policy. Meanwhile, we just borrow against that policy to finance our investments and our spending, and the savings we simply leave untapped inside of the cash value life insurance policy where it earns a competitive interest rate. And by the way, all of the earnings in the policy are tax-free because it's inside of life insurance, and because we're never realizing any gains, we're simply borrowing against the policy. Now, a policy loan is not a debt. Believe it or not, there are no repayment terms on that loan whatsoever. What we're doing is we're collateralizing our cash value life insurance policy, borrowing against it, similar to the way you would borrow against your house. So when we borrow against the policy, no money leaves our policy. 100% of the principal balance in the policy, the cash value, keeps earning for us interest and dividends uninterrupted. Conceptually, what we just did was we issued a loan to ourselves from our own private bank. We are now our own bankers, and we decide what the repayment terms on that loan will be. The insurance company that issues us the loan doesn't put any payment terms on it whatsoever, because the collateral that we're borrowing against is guaranteed by the insurance company. It's contractually guaranteed to keep growing, and there is a death benefit on that policy. So if you never pay a policy loan back, all that happens is the death benefit pays off the loan. So it's analogous to borrowing against your house, except much better because we're not taking on any debt. Everything is guaranteed. The asset is cash, so there's no market risk, and so on. So conceptually, this is how we become our own bankers. We are now going to finance all of our financial activity from specially designed cash value life insurance so that every single dollar that flows through our personal economy keeps earning for us uninterrupted, even while we spend it, save it, and invest it. So we pay yourself first by paying a premium into your custom designed whole life insurance policy. Those dollars now keep earning for you even while you're using them. So this is how you pay yourself first. Pay a premium into your specially designed cash value life insurance policy. Those dollars are now permanently captured inside your personal economy where they can never escape because we never withdraw any of them, and they keep earning for you tax-free at a guaranteed rate from now until the day you die. So we can effectively use every dollar twice rather than once, because every dollar is earning for us in the policy in addition to whatever else we use it for. So your buck stops here because none of your money ever leaves your policy, and you just stopped all the leakage in your personal economy. So all your cash value continually earns for you in your policy. Your dollars that you invest earn for you in the investment, and they earn in your policy. Conceptually, what's happening is you're earning in the investment, and you're earning as the bank that financed that investment, because you financed the purchase of that investment using a policy loan rather than cash. If you had paid for it with cash, then your dollars would only be earning for you once inside the investment. Here, they're earning for you inside the investment and inside your whole life policy. Your savings you'll keep in the bank, and your spending, all that leakage that's going on today, stops. None of that money leaves your personal economy because you didn't spend any of your money. You spent the insurance company's money by strategically borrowing against your policy to finance those purchases. So all those dollars that would have permanently left your personal economy when you spent it are now still earning for you inside your policy. So conceptually, what we're doing is we're financing all of our financial activity from our own private bank. So now we earn interest on every single purchase and investment we make.